All right. That is the news. Maybe the bigger question thus is around this England stuff. What does it mean for you and your money? Let's bring in Bob Pavlik, Chief Market Strategist at Boston Private Wealth, and Steve Dudash, President of IHT Wealth Management. Bob, first to you. Do you change how you invest your clients' money based on this Bank of England news today?
No, I don't, but I am at least somewhat more favorable on the banks because I think with this cut in interest rates and the additional bond purchases by the Bank of England, it's going to help some of these international banks like JP Morgan, like Citigroup. And so I think there is some favorable impact. But for the U.S.-based stocks, I don't think you're going to see much of an impact. I do think that the market was expecting something, and the market's expecting even more. We see the pound at $1.31. I think you're going to see it even go a little bit further going forward.
There's been no sector worse than the European banks, especially in Italy, but Deutsche Bank at lows, Commerzbank. Are you buying any of those? Do you feel like they've got a brighter future, perhaps, from an investment perspective because of what the BOE and the ECB are doing right now?
No, I'm not interested in those banks right now, but we're looking at banks like Bank of America, like JP Morgan, like Citigroup, even BlackRock. Lower interest rates means positive things for these companies going forward. We think that the United States is on track, probably for an interest rate hike in December, and then probably a little bit more as the economy picks up going into 2017.
Steve, what are your expectations in terms of rates? Because right now, as Bob had mentioned, rates aren't expected to move at all by the Fed until December. So does the BOE change your view at all?
I think we're in QE infinity now, and now they're coming up with new ways of making QE because they can't cut rates any more than they already have. I mean, we all expected the rate cut in England, or for the most part expected, but I don't know. I don't see how that helps banks. I mean, when rates are at zero, and it looks like we're going to be at zero for a while now, it's hard to see how that helps a bank's bottom line because that's where they make all their spread on it, and that's why they've been muddling through the last, what, 7, 8 years now. That on top of the fact, and I think we were talking about this before, with the real estate sector being added to the S&P 500, a lot of the stocks that, or the money that's been in the financial sector is coming out of that and will be going into that new real estate sector. That's only going to hurt from the passive investor standpoint. It's only going to hurt the ETFs and the financial stocks bottom line on that end too for an artificial outside influence. So it's hard to see how that's going to help the bank world, and I'd probably be avoiding them right now, at least for the foreseeable future.
Bob, how does this story end, Daddy?
Well,
Tell me.
I'm not sure how this story ends. I don't think anybody knows how it ends. I don't think Yellen knows how it ends. But let me just address quickly that point that Steve just made with how it's going to help the bank's bottom lines. These banks are trading bonds. They're also helping with the M&A activity, and they're also helping issue new bonds for corporations. And so I think corporations are going to actually buy back some bonds, buy back their paper, and issue new paper. And so there goes an investment banking fee that's associated with that. So I do think that it's going to help. It's not going to help their net interest margin, but I do think that it helps in other ways.
Well, you know, Steve, we pointed out this morning on Squawk Box that the FTSE 100, Britain's Dow, is the best performing stock index in Europe over the past 3 months. It's been up 8.5%. It appears the market is largely, I don't want to say front run because that has sort of a negative connotation, bet on this outcome. Are these, do you think, all the gains that they see, and maybe that means more money comes here?
I got to believe that you're going to continue to see, like the U.S. market right now, it's not like that we're crushing it, we're the best market out there, but it's everyone else is doing so poorly, or there's so much risk that's inherent in it, it's hard to put money into bonds, it's hard to put money into Europe, given that, yes, right now parts are doing okay, but it's an unknown game plan. This has never happened before the unloading of a country from the EU. You can't put a lot of money in the emerging markets just because it's a heavily risked thing. So if you're looking for a certain area that's benefiting it, I think that's why we're seeing the U.S. market's been doing better than what a lot of people would have expected at this point in the year. And I don't know if you can continue to say that you'll see that out of the, you know, England, European markets, at least in the foreseeable future. They've got some major issues they need to work out, and it's all going to be coming up here in the next few months of what that plan is going to look like. So that's not, if I'm looking to overweight somewhere, yeah, you know, the U.S. wins almost kind of by default.
Yeah, I will correct you a little bit and say that Europe has had some issues to work out for the last 50 to 100 years. Bob and Steve, thank you both very much, guys. We appreciate it.
Thank you.
All right, let's get a news alert now on Facebook.